Welcome to the Utah Retirement System's webinar series. While this webinar has been pre-recorded, the information is still relevant. Please see the description below for links to the different sections within the video and other helpful information. We hope you find this webinar to be a useful resource in your retirement planning.
Right. Welcome, everyone, and to today's webinar, Roth conversions, to convert or not to convert. That is the question. And I need to make an immediate apology to Shakespeare and Hamlet for taking a play off of to be or not to be, which was that famous question. But for a lot of us, it is a question because there are a couple ways to get money into Roths, and one of those is just through the normal payroll deduction or writing a check once, twice a year to get money into a Roth. But you can also bring money into a Roth from existing retirement accounts, and it's the conversion piece that we're going to focus on today. So, question, why bother to do this? Why would anyone want to convert to a Roth IRA? Well, of course, one of the big benefits to Roths is that when you take money out of a Roth in retirement, assuming you meet the qualifications, that all of that money coming out can be entirely state and federal tax-free. That could include the dividends, the income, the growth, the earnings, all of it could be completely tax-free. Also, your tax rate may actually be higher in retirement, depending on what happens to future income tax rates, or simply depending on the overall retirement savings you have. In our system, the Tier 1 and Tier 2 benefits are taxable, 401ks, 457s. If you're in the school system, 403b money, all of that is taxable. And for many of our members, the bulk of Social Security turns out it is taxable. So possibly the only tax-free resource might be money coming from a Roth. And again, if tax rates go up in the future, having tax-free money from a Roth can be a pretty sweet deal. Also, when you turn 70 and a half, the IRS actually requires that you start taking money out of pretty much all accounts with the exception of Roths. And so if you have 401ks, traditional IRAs, 457 plans, you turn 70 and a half, the IRS says you've got to start taking money out of those accounts whether you want it or not. And if you have significant balances in those accounts, say 100,000, 200,000, that can start adding some pretty serious money to your income taxes or to your income in retirement, which can raise your taxes in retirement. And so in some cases, it makes sense to convert now all the way up, say, through your 60s, because as you shrink your existing 401k, traditional IRA balances, that also shrinks your future required minimum distributions, those RMDs. And of course, another reason, as I mentioned, you never have to take money out of a Roth IRA if you don't want to, as far as the original owner is concerned. So for some folks, it's just the idea of, I want to keep my life simple when I'm in retirement. I never have to worry about taking required minimum distributions. In fact, everything, when I do take it out, is all tax-free. So that also simplifies my whole tax preparation process. Note, for Roth IRA owners, there are no RMDs. Roth beneficiaries, though, do have to start taking required minimum distributions. That's a whole different set of rules and a whole nother topic. But those are some typical reasons why folks want to convert the existing 401k traditional IRA money to a Roth IRA. And of course, for those beneficiaries, that money does go tax-free to them. So that's the good news there. The money would not be taxed to those beneficiaries as well. So sometimes for legacy purposes, it's a nice way to pass your retirement assets on to your kids, grandkids, whatever the case may be, and you pass it all tax-free to them as well. All right, what and when can you convert? So if you have, for instance, an old 401k, let's say maybe you worked in the private sector before you joined your current agency, maybe you've moved around from a couple jobs, you have old 401ks, or say at a sitting with an old employer. Those you can convert anytime. Your current 401k, the one you have through URS now, you can't start converting that till you're at least 59 and a half, Or basically, anytime you retire or terminate, then you could go ahead and start converting the 401k at that point in time. For the 457 plan, again, very similar. If you have old 457s, maybe you've moved around between different agencies. Maybe some of those use firms that were not URS. Those you can again convert anytime you want to. However, your current 457, as long as you're still working, you can't start converting that until 70 and a half. But again, anytime you retire or terminate, then you can start converting the 457 whenever you want. Traditional IRAs, interestingly, you can start converting those anytime. Doesn't matter the age or anything. So, if you have an IRA at a bank, you have a traditional IRA at URS, a mutual fund company, those you can convert anytime you want to. So, let's see. Let me ask, we've got a question here. We've got a question that says, I'm hoping you'll explain when it makes sense to convert my 401k or 457 and why. So I think we just kind of touched on that. Again, it's going to go back to some of those earlier reasons, right? So timing wise, you can convert 401k or 457, again, depending on when you have retired, when you've terminated. But again, the earlier reasons we were talking about, maybe you want to reduce future required minimum distributions, maybe you want just tax-free income in retirement. All those reasons are reasons why you might want to start converting sooner than later. All right, we've got a little polling question coming up. Someone else is asking, by the way, what's considered old? Sorry. By that I mean it's from a former employer, and essentially it's just not here at URS. So your current employer, in your current employer's plan, you can't start converting that, again, typically if it's the 401k till 59 and a half. But if you have a former employer's 401k, and maybe I used to work in the private sector at a bank, and then I joined the local school system. Well, my bank 401k, that's an old 401k, if you will, that I could start converting. All right, so we got a polling question for you, and just dive in and answer this. How much are you able to convert into your Roth IRA? How much do you think you can convert into the Roth IRA? We'll give you just a couple seconds to answer that. And everything's anonymous, so don't worry, you're not being graded whatsoever. All right, so the answer essentially is any amount you want to. Now, remember I said there's two ways to get money into a Roth. There's the normal new money coming in, and that's the $6,000 or $7,000 limitation that's a per year limitation. But if you have existing, like I said, 401k, 457, traditional IRA money, and again, depending on whether those are with former employers or the traditional IRA, those you can convert any amount that you want to. Does it make sense to convert all of them at once? Well, that's part of what we're going to talk about. But technically, if you want to convert 5,000, 10,000, you can do any amount you want to because it's coming from an existing retirement account. Now, there are tax consequences, so you kind of want to think through how much you're going to convert. State and federal income taxes due, and if you're under 59 and a half, there is no early withdrawal penalty, such as with traditional IRAs, for instance. So the good news, if you want to go ahead and convert, Uncle Sam is very happy to let you convert, and he won't penalize you for doing so. But you will always, of course, have to pay federal income tax. And here in Utah, you would pay state income tax as well. Ideally, you want to use non-retirement cash to pay those taxes. Okay, and by non-retirement cash, I just mean maybe money sitting around at the bank in a savings account, a money market account, a CD, something like that. Kind of refer to it as like a taxable account. It's not a retirement account. And the reason you want to do that is, say for instance, right now, maybe that's in the money in your savings accounts, maybe it's earning you 0.5%, 1%. It's really not doing anything for you anyway. Well, go ahead, if you make the Roth conversion, you can use that money, that asset that's really not doing a whole lot for you, and use it to pay the taxes. So let me give you an example. Let's say I convert 10,000. Again, this is from a former 401k. Let's say, again, I worked at a bank 10 years ago, still have a 401k sitting there. I want to convert 10,000 from that to my Roth IRA. I have to add 10,000 to this year's tax return. All right. And so maybe that doesn't hurt me, let's say income tax wise. I'm still going to stay in roughly my same tax bracket. Now, what if I had 100,000 at the old bank 401k? Well, if I convert $100,000, I have to add 100,000 bucks to this year's tax return. That probably would push me to a higher tax bracket, which ultimately means I wind up paying more income tax. So the good news with conversions, you don't have to, it's not an all or none. You don't have to convert all at once. Tax advisors will typically tell you, convert in such a way that you keep your taxes as low as possible. And we're going to look at some examples of how that might work. So let's say here in 2019, for instance, let's pretend you're married filing jointly. And by the way, here's the really good news. On a couple of these slides, we're going to go pretty deep with some numbers, and some of this you may kind of go, wait, I wish you would repeat that. We are recording the webinar, and so when we get it back out on the website, it might be a week or two before we get it up on the website. If I go through a section and you're like, that still didn't quite make sense, I wish you would repeat it, man, just after it's up, come back and rewatch the webinar. You can fast forward to the sections you want to. You can sit there and rewind it as many times as you want. But here's a relatively simple tax example. All right, on the left side, it's 2019. Let's say it's my wife and I. We're married filing jointly. Between the two of us, we have adjusted gross income of $100,400. Adjusted gross income, that's basically the bottom of the front of the 1040 tax form, if you will. Nowadays, we get to knock off what's called the standard deduction. For married people in 2019, it's $24,400. That makes our taxable income $76,000. Taxable income is really one of the key numbers you want to pay close attention to, because that's what determines what tax bracket you're in. It's not your adjusted gross income. We hear people say things all the time. Oh, I'm making 100,000. That puts me in the blah 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 tax bracket. Nope. It is taxable income, meaning after any deductions. So in this example, 76,000 of taxable income, that means I could convert another 2,950. Where did I get that number from? Well, over to the right, in the 12% tax bracket, I can have up to a total of $78,950 and stay in the 12% tax bracket. Okay, so you kind of get the idea there. 76,000, the upper end of the bracket, 78,950. The difference is how much I could convert and still stay in the 12% bracket. Well, what's that costing me? Well, 2,950 times 12%. So to convert that almost $3,000, it's going to cost me about $350 in taxes. Said more generally, if I'm in the 12% bracket, every 1,000 that I convert costs me 120 in federal taxes. Not too bad. But if I jump up to that 22% bracket, every 1,000 I convert now costs me $220 in federal taxes. That's about an 83% jump. So you can see if you move from that 12 to the 22% bracket, taxes start to get pretty significant. And if you look at the tax rates on the right-hand side, for instance, if you were to go from the 24 to the 32% bracket, that's a pretty significant jump as well. So again, if you need to kind of go through this again, catch the recording, rewind it. So, and of course, you've also got potential state income tax on this as well. So when it comes to converting, strategy-wise, kind of what makes sense? General rule, convert enough any given year to fill up whatever your current tax bracket is. General rule, always fill up the lowest bracket. The lowest bracket, 10%, even the 12%. Those are considered pretty low. You don't want to convert those so much that it pushes you up to those higher tax brackets. And realize tax brackets will increase or decrease over time. I've got just 10, 15, 25%, just kind of as an example here. The actual brackets today are actually like 10, 12, 22, like you just saw. A couple years back, they were 10, 15, 25. And again, over time, these things are going to be higher or lower depending on what's going on with Congress. But kind of that general strategy, try to fill up the lower brackets, the lower buckets, if you will, for sure, but you kind of want to try and avoid anytime you're making a pretty significant jump, like from 12% to 22%, or if the 10, 15, 25 were the current brackets, try to avoid going from 15 to 25. It just costs you more in taxes. And again, the good news, you don't have to convert all at once. So convert enough to fill up those lower brackets, kind of lock in your taxes at those lower rates. So you do have, basically, when you're doing Roth conversions, it is a year by year type process because things, you'll have more income, taxable income some years, you may have less, depending on what's going on, jobs, all that good stuff. Or the tax brackets may change as well. So next question is, so when do we want to convert? And so we have another little poll question here we want to shoot at you. So think about this. When might be a good time of year to actually make a conversion? Maybe the end of the year, the middle of the year, start of the year. What do you think? When's a good time? Give you a couple more seconds. Getting pretty good responses here. Dive in quick. All right. So as it turns out, the end of the year is a pretty good time to actually make conversions. And why might that be? Well, if you stop and think about it, late in the calendar year, you probably have a pretty good idea of how much your income is going to be for that entire year, right? You'll have a good sense. Yeah, we've had 10, 11 months of salaries or whatever the case may be. Got one other quick question here. Oh, thank you. So someone's asking, can I convert between January and April 15th for the prior year? And the answer is no. Conversions are always calendar year. So if you make a conversion in February, it's for February of that year. If you convert in October, it's for October of that year. IRAs are a little confusing when you're adding new money because there are the rules that say, for instance, in March of 2019, I could have made a contribution for 2018. Those are the contribution rules. For conversions, conversions are always in the current calendar year. So if I do convert, let's say late in the year in this example, because I have a pretty good sense of what my income is going to be, that's probably a good time to go ahead and make the conversion. Also, in general, if you're in your 60s and you've retired, if your income does go down, let's say maybe you're just, you're in the tier 1 or tier 2 system, and that's the only money you're drawing on. Maybe you're delaying Social Security because, and this is another topic as well, but if you wait to delay Social Security, the longer you wait, the bigger that benefit becomes. But Social Security is also taxable, which means it's going to raise your taxable income. So that can also be a good time to convert. Maybe your income has dropped down. That gives you more room in that bucket, if you will, to make bigger conversions. So some general tips for you to think about when it comes to doing conversions. Always, always talk with a tax advisor before you do a Roth conversion. Okay, can't stress that enough. This is not one of those try this at home on your own. This is just like the professional stunt commercials. Do not attempt this at home. We always encourage you to talk with a tax advisor first because sometimes the rules can be a little tricky. You'll know most of them after hearing this webinar, but again, it's always good to have someone hold your hand, at least maybe for the first couple conversions, so you really understand what's happening. Each Roth conversion has its own 5-year clock, though, for tax-free earnings. So for instance, I make a conversion this year in 2019. You got to be past 59 and a half, by the way, to take money out of a Roth, totally tax-free. But for conversions, not only do I have to be 59 and a half, the conversion amount and any earnings associated with it has to have been converted for at least 5 years. So 2019, I make a conversion. 2020, 2021, 2022, 2023. Sometime in 2024, I can start, if I'm over 59 and a half, I could start taking the earnings from my 2019 conversion. I make another conversion in 2020. Well, now I got to wait 5 years. So sometime in 2025, I could start taking the earnings from my 2020 conversion. Okay, so that's basically how that works. So each conversion does have its own 5-year clock. And of course, you have to be past 59 and a half. Traditional IRAs, and again, these are the ones that are more flexible because these you can convert anytime you want to, but even these can be a little tricky. And again, this is one of the big reasons we encourage you to talk to a tax advisor. Traditional IRAs convert by what we call the cream in the coffee rule. You're like, okay, what the heck is that? Let's think about this, for instance. Again, this only applies to IRAs. So let's pretend Corey has 2 IRAs. He's got 80,000 bucks in pre-tax money at URS, traditional IRA, and by pre-tax meaning over the years he's been able to take a deduction on his tax return for putting money into the traditional IRA. But he's also got 20,000 of after-tax money, say at a credit union IRA. And after-tax money could mean, for instance, in a traditional IRA, there were years he was still allowed to put money in the IRA, but he wasn't able to take a deduction for it. Maybe because he had too much income or because he was covered by an employer retirement plan. Tax advisors, by the way, will sometimes refer to after-tax money as having basis in it or non-deductible IRA money. So he's got 80,000, 20,000. The question is, can Corey convert just the 20,000 in his credit union IRA tax-free? And the answer is no. Now, a lot of people want to do that, and they assume they could do that because they think, well, it's the after-tax money. He didn't get a tax break on it. So if you convert just that after-tax money, no tax would be due when you convert it to a Roth. And that would be great. But that's not the way the IRS sees things, and those are not the IRS rules. The cream in the coffee means that all IRAs have to be aggregated. Okay, well, what exactly does that mean? So in this case, we take the 20,000 of after-tax money, divide it by the entire IRA amount, all $100,000. That means Corey has a 20% conversion ratio. So when he goes to convert his traditional IRAs, if he converts 20,000 thinking he's getting just the credit union money, actually only 20% of it is deemed to come from his credit union IRA, which would basically be 4,000. Instead, 16,000 is now going to come from that pre-tax IRA, which is going to be taxable. So Corey may have thought, oh, I'm converting just the 20,000 of after-tax money. I'm not going to owe any income tax on this. Uncle Sam's going to come along and say, wait a minute, actually, you owe tax on $16,000. That's not the kind of surprise most people want. And again, that's one of the reasons we encourage you to work with a tax advisor if you're thinking about doing Roth conversions. You don't want to get tripped up on these things. So always consult. Think about the cream in the coffee rule. Be careful because once you do a conversion, you can't undo it. Uncle Sam won't let you. Now, a couple years back, you used to be able to undo Roth conversions, but going forward, you cannot. So, like a prior example, if Corey had gone and converted 20,000 bucks and then he was like, oops, that wasn't what I wanted to do, too bad, so sad. Uncle Sam's not going to let him off the hook. He's going to owe tax on that 16,000. Now, a good investment, because you got to think too, you get a choice as far as what you convert and for Roth conversions, particularly if you have multiple investments, say inside your 401k or inside your traditional IRA. What do you want to convert? Well, ideally, you want to pick something that's down temporarily in value because that means you can convert more shares. It's kind of like converting when things are on sale. So let me give you an example. So the target date fund from 2035, let's go back to the fourth quarter of 2018. You may remember fourth quarter of 2018 was not a particularly great time for the markets. But let's say, for instance, on the left side, you had decided to make a Roth conversion from your traditional IRA, 10,000 bucks worth on October 1st of the target date fund 2035. We take 10,000 divided by the share price. You would have converted roughly 742 shares that are now over in a Roth IRA account. 6 months later, end of the first quarter, March 29th, the price was about $13.24 per share. So your value would have been 98, roughly 98.22. So you basically would have gotten back to even, right? Because the first quarter was actually pretty good as far as the markets were concerned. Now, let's say over on the right side, just for whatever reason, you still were going to go ahead and convert 10,000, but you waited till December 31st, just pure luck, for instance. Well, December 31st, the target date fund, because of that really kind of ugly fourth quarter, was down to 12 bucks a share. Well, that meant you obviously converted more shares. In fact, you would have converted 833. Another 3 months later, right, end of the first quarter, same share price, 13.24. Now your account value, 11,000 bucks. So you would now have $1,033 of gain that was going to be tax-free for you. Again, you had to wait the 5 years. So again, the whole point, try to find something. If you're making a conversion, going to do it late in the year, have a good idea of what your income is, but also then maybe look for an investment that's kind of temporarily out of favor, that's sort of down in value. And sometimes this can actually be kind of, like I said, good news. You may kind of, end of the year, you're kind of like, oh, I'm having a bad year, my investments are down. That can be actually prime time to think about doing Roth conversion. That can actually represent pretty good opportunity. All right, so back to the tips. Try to convert something maybe that's down in value, hopefully something that's going to come back. If you're 63 or older, watch out for Medicare premiums. The way Medicare works is it has a 2-year look back, and they look back at your tax returns for the prior 2 years. They look at your overall income level, and that can affect how much you're going to pay in terms of Medicare premiums. And the details for that, again, that's a whole nother webinar too. So for instance, when I'm 65, that's the earliest I could qualify for Medicare. Medicare is going to look at my age 63 and age 64 tax returns, add them together and say I made whatever X amount of dollars, and that's going to cost me, therefore, a certain level of Medicare premium. When I'm 66, they're going to look at my 65 and 64 tax returns. When I'm 67, on and on and on. Roth conversions count as income. So again, if you convert too much in any given year, let's say when you're 63 or older, that could inadvertently push your Medicare premiums up. So keep that in mind as well. All right. We're through kind of the tough stuff, if you will. So how do I convert? Well, a couple ways. First, you can always call our savings department. Phone number is listed there, 7720. We can explain the process to you, send you out the appropriate forms, or you can download any forms you need, log into your MyURS account. We have an example, the form there on the right, the Roth IRA application, conversion application form. So that's how you actually go through the process. You'll indicate on there how much you want to convert, when, etc. If we've gotten to this point and you're kind of like, okay, this was helpful, but boy, I still would like to sit down with somebody, maybe face to face, and kind of talk through this, strategize, make sure I really understand things. You're always welcome to sit down with myself, one of my colleagues, one of the retirement planning advisors here. Just log into your MyURS account. You can sign up for a one-on-one session. We can explain, for instance, all of the Roth conversion rules. Now, we're not tax advisors. We can't tell you how much to convert, for instance, or, should you convert this investment or that one, or all that good sort of stuff. But we can certainly educate you on the process, make sure your understanding is clear so that when you do go talk with a tax advisor before you make that Roth conversion, that you have a good understanding, you can ask questions appropriately. If you want to sign up for one of those sessions, you want to sit down with us face to face, log in, click on the Education tab, and then on the left side, once that page opens, click on Individual Retirement Planning Sessions. You'll see all the dates, times, locations, and then just pick one that works for you, sign up, and again, we'll answer Roth conversion questions. Technically, we can answer all kinds of questions though. If you're debating about putting money into a 401k or a Roth, trying to figure out which payout option to choose if you have pensions, really any retirement questions you can always ask us in these individual retirement planning sessions. We do run these sessions all over the state. So when you get logged in, again, you'll see dates, times, locations. If you don't see something nearby that week, maybe log in again, say a week later, because we're always posting new sessions. But we are here for you as a resource. We want to make sure you understand these things as much as possible. So take advantage of it. And with that, that will pretty much conclude today's Roth conversion webinar. Thank you very much for attending.